Okay, so hello everyone. Welcome to this sort of preview of the non-farm payroll. Just for the record, I'm recording this on Thursday, January the 4th, early evening. So we still have a few hours before the non-farm payrolls, but technically it's just, sort of the day before. Okay, so let's first of all start with a bit of context. And we know that really what got the market's attention recently was on December the 13th. This is a daily chart of the 2-year yield. It just serves as a little bit of an example here. But we can see that on December the 13th, a few things happened. Basically, the dot plot from the Fed indicated that the Fed, or the FOMC to be more precise, was sort of happy or forecasting sort of three rate cuts over the 2024 period by the end of 2024, which essentially was a little bit more dovish than the market was expecting. We also got, in the press conference following the release of the statement and the summary of economic projections, we had a fairly sort of upbeat and benign and dovish Jerome Powell, who essentially sort of led the market to believe that the Fed was, taking a bit of a victory lap. There'd been a lot of sort of progress on inflation and essentially it was time maybe to start thinking about rate cuts at some point. I mean, I'm kind of simplifying there. But essentially what you can see, let's say, for example, on this daily chart of the 2-year yield, December the 13th, boom, there was a complete collapse for 3 or 4 days of the yield. And another way of looking at this, if we look at some of the sort of pricings for the Fed kind of cuts, let's just have a look at a few different things here. We can see, let's say, for example, if we look at the March, the March, I'm going to put this on a, let's see what I'm going to do. I'll put this back on, I'll go back 20 days on a 1-hour chart. And what this is saying here, this is the number of basis points priced in for a particular Fed meeting on the right-hand side. So you can see that if we go back here to the Fed, which, as I said, was the 13th of December, you can see that prior to Powell, only about 12 basis points, or essentially a 50% chance of a cut, the first cut coming in March. And then after Powell and the press conference, that went all the way down to basically about 28 basis points, which was more than a full cut. Now, subsequent to that, it's kind of stabilized a little bit. And what we can see, and we'll just put this more on, let's say, a 15-minute chart, going back maybe, I don't know, let's say sort of 10 days or so, we can see that the market has sort of essentially walked that back. So what we have is two phases where the Fed was giving dovish signals. And then essentially ever since then, and I saw a good headline today, they've tried to put the toothpaste back into the tube. They're trying to sort of say to the market, whoa, 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 everything was too dovishly priced. There's still more work to do. Maybe there's more sort of hikes to do. And maybe the market's got, in front of itself a little bit. And that's where we've been. So you can see that here, if we just look at this sort of chart here, which is, as I say, it's a 15-minute chart, just telling us what the market is pricing in for the March meeting. We can see that, ever since, the last 4, 5, 6 days, the end of December and going into the beginning of this new year, 2024, we've gone from, a full cut priced in 25 basis points, just around about Christmas, until now we've got about 17. And that's just because the data continues to come in quite strong. And also we've had a lot of Fed speak that various members of the FOMC have been pushed out by Powell, probably just to sort of calm the market down and say, hey, we need to be thinking a little less dovishly. So that's kind of the context of the situation for non-farm payrolls tomorrow. So let's now actually just look at a little bit of the most relevant recent data. And really what the market is trying to figure out tomorrow is the following. In order for the dovish pricing of the Fed to be justified, and let's just see what actually is priced in at this point, and just look a little bit. So what we can see is that for the January meeting, the market's only pricing in 1 basis point. So that's nothing. The market is not at all expecting the Fed to do anything in January. Fine. As we just saw for the 20th of March, we're now pricing in about a 70% chance of a cut. So there's still a 70% chance of a cut, not 100%, which was priced in, a week or two ago. And that, as we just saw, has been going down. It's now at 17 basis points. But then, coming into the first cut, we've got 38 basis points. So essentially it's a cut and a half. Priced in for May. And then by the end of the year, if we go, let's say, to 18th of December, we see about 5.5 cuts have been priced in, which, at some point was about 6.5 cuts. So at this point, we have about 5.5 sort of cuts priced in by the end of the year, which is, around about, the delta from now, the change from now is about 135 basis points, something like that. So essentially the market is still saying, as you can see from the graphic here, that the Fed will cut. And in fact, they're saying the Fed's going to cut quite aggressively, 5.5 cuts, whereas before it was 6.5. So it's not at all like the market's saying the Fed is not cutting. So really what's been going on in the last few days and what we need to figure out and what's going to be so important tomorrow is if the data continues to come in sort of strong in the real economy, does the market have to continue this sort of process of repricing? And so tomorrow we're going to get a little bit more information about that. But just in the time being, let's get back to the labor market, because what we are seeing is that inflation data and prices paid data seems to be coming down a little bit. But tomorrow, we're going to get more of an update on the labor market. Now, let's just look at sort of recent data. We got at the beginning of the year, we had ISM manufacturing. Again, keep in mind, guys, this is a survey, and the survey data has been weak. It's not hard data, it's survey data. But nonetheless, the ISM manufacturing for the jobs, sorry, where are we? The employment sort of component, that actually was quite strong. So actually, that was forecast, last time it was 45.8. Forecast of 46.5. So that actually came in quite strong, 48. So first of all, at the very beginning of this year, just a few days ago, ISM manufacturing employment was strong. The next number we had JOLTS numbers, of course, which was yesterday. So the JOLTS number came in a little bit on the weak side. So that was indicating that, the labor market was weakening a smidgen, just a little bit. Okay, that's interesting. But then we had ADP, and ADP this morning, of course, came in pretty strong. So 125,000, it came in at 164,000, which was higher than expected. Now we know that that's not super correlated for the non-farm payrolls, but it does give us sort of a general sense of where we might be going for the establishment survey. So we had ADP, and then we had the initial jobless claims, which came in at 202,000, so lower than expected, which of course is indicating less people claiming unemployment benefits for the first time. And we also had the continuing claims, which was a little bit lower than expected. So I would say that overall, the employment numbers are looking, relatively robust. I mean, JOLTS was a little bit lower than expected, but certainly we don't have any sense that the labor market is falling off a cliff. Now, what's also interesting is that after the non-farm payrolls number tomorrow at 8:30, at 10 o'clock, we'll get a bit of an update on the ISM services, which is pretty important. So if we just go down here a little bit, we'll get the the ISM services number, which is going to be coming in at where are we? Yeah, where are we here? At 10 o'clock. So that's expected for the employment was pretty strong last time. Okay. So all that to say that the numbers are coming in relatively robust. And just looking here on the Bloomberg, at least the Whisper number, which is a little bit of an informal survey of what sort of market participants are thinking. The Whisper number at this point is about 185,000. So let's actually now look at the numbers and see what's expected. So I think the bias is for a relatively robust, even maybe a slightly strong number. So if we actually look at it, these are the key numbers here, and I'll just try and make this a little bit easier to read. Okay, so obviously the most important number is going to be the headline number, which, as I say, is forecast. The survey is for 175,000. The Whisper is 185,000. So that seems to make sense. Now let's actually just look and have a look and just see the range here. So what we're seeing here, we have about 60 odd kind of sort of economists with their forecast. So the range here is between 80,000 and 235,000. So a fairly large dispersion. And what I think is always super important is to understand the standard deviation, which is going to move the algos and in basically the market reaction. So let's just call it 25,000. So 25,000, I'm going to write down that, got a standard deviation of about, plus or minus 25,000. And so we have to think in terms of one standard deviation, 25,000 plus 2 or minus 2 is going to be 50, 75,000 or 100 before standard deviation. So that's definitely the most important thing. And as you guys know, anything more than one standard deviation, so in this case, it looks like about 25,000, give or take, or sort of plus or minus 185 is going to be market moving. So let's say to the upside, that would be, let's say, a Whisper number of about 185,000. So we'd call that, what's that? So that's about 210,000. On the downside, that'd be, let's say, about 185,000 minus 25 would be about 160,000. So start thinking in terms of standard deviation, just to try and judge a little bit the magnitude of the market's kind of reaction. Okay, so that's important. But there is, as I say, quite a lot of dispersion in the viewpoints, and we do have some people calling for a pretty low number of even down to like 100 or 80,000, and the high estimate on the 235. Okay, so that's interesting. The next thing to look out for, guys, is obviously, as always, the revisions. Always very important to be looking out for the revisions, which is the previous 2 months. That will, you need to kind of factor that in with the headline number. I wouldn't worry too much about the manufacturing, because we actually already had some of that information. The important thing here is obviously going to be the unemployment rate. Now, keep in mind that the headline number here, the change in on-farm payrolls, is the establishment survey, which literally is relatively similar to the ADP. That looks at the the number of jobs in workplaces. Whereas the employment rate, which is here, forecast to go up a little bit, the survey from 3.7 up to 3.8. And remember, that is the household survey. So that's literally the Department of Labor Statistics are calling up, I think it's like 60,000 representative households and saying, did you have a job? Were you looking for a job? All that kind of thing. So it's technically a different survey, but nonetheless, it does get the market's attention. Again, let's just have a quick look at that. That's expected to come in at 3.8. The dispersion, I always like to see, is anything between 3.6 and 3.9. So obviously 3.7 or 3.6 would be very, very dovish. Anything 3.9 would indicate a weakening, or actually that would be dovish, a weakening sort of a survey there. Okay, so just keeping and going. The other number, which is going to be quite important, I also always like to look at the participation rate. Probably not as important at the moment. That was something which was maybe more important where we're more focused on inflation. But talking about inflation, probably really what's going to be very important is of course going to be the average hourly earnings. Now that's forecast to actually come down, as you guys can see here, 0.4. The survey calls for 0.3. That's going to be very important just because, the name of the game is that the Fed has 2 mandates, as we know: full employment as much as possible, and we have a very strong labor market. But the second one, of course, is the famous inflation. And so the general sort of feeling from the Fed, we had the Fed minutes on Wednesday essentially saying that, inflation seems to be drifting downwards. Still more work to do, according to the Fed, but definitely seems to be pointing in the right direction. So the market will want to see further evidence that price pressures, wage pressures are drifting downwards. And, the survey is calling for plus 0.3 rather than 0.4. And let's just have a look and just see what the dispersion is there. Probably, 0.1 low estimate to a high of 0.4. So, quite a big sort of estimate there. Keep the standard deviation there as 0.06. And just keep in mind, guys, that the estimate here, it actually is rounded up or down to just one decimal point. So it's kind of interesting just to note that the standard deviation is 0.06, because the point I'm trying to make is that if it comes in at 0.2 or 0.3, you really want to know if it's a low 0.2 or a high 0.2. That could make a little bit of a difference. So, on Twitter or whatever, just try and understand what the real unrounded kind of number is. Okay, so just looking at everything here. What are the trades here? So obviously, like just to put it in sort of general terms, what the market is trying to understand. We had relatively sort of robust sort of data and surveys coming out over the last 2 or 3 weeks. Actually the last 2 or 3 weeks. And so the market is saying, well, okay, the Fed seemed to have been pretty dovish in December the 13th. But since then, the market has corrected a little bit. We see the stocks have come off. We see gold has come off. We see the bond yields have gone up. We see the curve has, let's say the bond yields have come down. And we see the US dollar has strengthened a little bit, basically on this idea that the market was thinking, whoa, we've got us ahead of ourselves a little bit. We've been pricing the Fed after Powell a little too dovishly, because actually the real economy is still pretty strong and pretty robust. So maybe the Fed doesn't need to be cutting in, certainly not in January, and maybe not even in March, as the market had been expecting. So the first thing to figure out is this whole idea of will they or won't they be doing their first cut in March. Maybe it's more appropriate to think about that in the May meeting or even the June meeting. And so generally, that's really where the market is trying to sort of figure out what's going on here. It's not so much, oh, they will never cut or they will cut a huge amount. It's really just that nuance of when and by what magnitude. So one way, of looking at all that stuff is to have a little bit of a look at some of the just the way the curve has been changing a little bit in terms of the Fed pricing. So again, just a quick little thing here. This is an hourly chart going back, again, going back to the Fed meeting. And you can see here, this number on the right-hand side is for the number of cuts. So the number of cuts priced in by the market for 2024. And you can see where we are at the moment is about 5.5 cuts, which equates to 5.5 multiplied by 125, which is about 137 or something like that, 137 basis points. But what you can see is that before Powell, that was only about 4.5 cuts. And at the most dovish, just after Powell, that got down to about almost 6.5 cuts. So essentially, the market has hawkishly priced Powell, but not enormously, by about one cut over the period of 2024. And as I say, another way to look at that is to which we saw a little bit is just for, let's say, for the most one of the upcoming meetings, which is the March meeting, is just to see how many basis points. And again, as I pointed out before, guys, you can see that had been at about 28 basis points here, but it's now only 17. So this is really what you need to be looking at and understanding the market reaction. And of course, that is going to move everything else. So what are some of the trades? So personally, what I'm looking at, let's just look at a few things from the short-term interest rates, because that's going to give a lot of early kind of information. And just what I want to share with you guys, you can see this kind of repricing situation. If you look at something like, let's just go in some of the short-term interest rates. So that's like the 3-month, very short end of the curve. And you can see here, so for example, if we look at, this is the March 2024 SOFR contract, which I'll just put up here. You can see how this is on the daily, but maybe what we can do, we can put this on a, I don't know, maybe we'll put it on an hourly chart if that works. Let's see if we can go all the way back. No, maybe that's a little bit optimistic. We'll put that on, actually, we'll put on a 4-hour chart just to see. And so you can see here that, again, this is going back to the Fed and Powell. And you can see here on that dovishness, it ripped a little bit and then it's come back a little bit, about 50% or so. That's for the March meeting. So for the March contract, if you look actually at the December 24 contract, you can see that it actually went up a bit more aggressively but also has come back a little bit there. Now, what's actually interesting in a way, which is a kind of interesting just to think about all of this. If you go on the CME website, you can actually look at the SOFR tool, and you can see here what's priced in by the market currently. So you see here. You see here, this is the FOMC meeting date. So you see what's priced in is for January is 0, nothing. But the market at the moment is pricing in 25 basis points for the 20th of March. And you can see here, 25, 25, 25, nothing for July, then 25, 25, 25. So, almost about 6-ish cuts. But what's interesting about this tool here is that you can see down below here, you can see that the current pricing is the red, and you can see the predicted, according to what is priced into the future curve here, is the blue. And obviously that's basically on top of each other because that's just what the pricing is. But what we can do is to play around with that and sort of to gauge a little bit how this curve will change. So let's say, for example, we say that if the market wants to price out this cut here, so we'll go into the March and we'll put that at 0. So what I'm basically saying to the machine is, hey, what happens if the market starts pricing out the Fed cutting? So I'm going to calculate that. And I want you guys to look at this curve down here. Okay, just put that in your mind's eye for a second. And I'm going to calculate 3, 2, 1, boom. And you can see how that suddenly the current one is the red, and you can see that the price, which is the blue, actually comes down, which is hawkish. So the price of the whole SOFR curve will come down. And what's actually great is that you can see here by how many basis points. Now you can also see that here you see SR3. So what we see here, guys, is that if the market sees tomorrow that the non-farm payrolls is strong and basically is trying to communicate that, oh, that means that maybe in the March meeting, instead of being a 25 basis point cut, it'll be a 0 basis point cut. We can see that technically, if the market wants to price out completely the possibility of the Fed cutting in March, we can see that in, for example, the Z3 contract, which is the December 23 contract, it would only move down 5 basis points. But you can see that in the H3, which is March 2024, it would move 19. But if we go all the way out to, let's say, September of 24, that would move 27. If you go out to December 24, that would probably move like 30 or 35 basis points. So you can see that the magnitude of the repricing for the individual contracts would be pretty significant. And we can see that here. We can see that, let's say for Z, so December 23 would be 5 basis points. We can see for March it'd be 19 basis points, June 24, September would be 27, and probably December 23, which they're not showing, would probably about 30 basis points or so. So that's kind of interesting because that gives you a degree of the magnitude. Now, keep in mind that if you're looking, for those of you who trade on the futures, the TT, keep in mind that 1 basis point here is equivalent to 2 ticks. 1 basis point is equivalent to 2 ticks. So if we're thinking that the market wants to sees that the data tomorrow is hawkish, and it wants to completely price out what is currently priced in, we're talking maybe like 18, 20, 25 basis points, which would be something like equivalent of 40 or 40, 50, 60 ticks. Each tick is $12.50. So remember that on these futures, that 1 basis point is equivalent to $25. 1 basis point, $25. 2 ticks equals 1 basis point. Therefore, 1 tick is equal to $12.50. Okay, that's the way to think about it. So that's kind of interesting to look at it that way. And then we can sort of start to go back and look at a few different charts and say, well, hold on. If you want to just avoid some of the volatility, you can start looking about spreads, and you could start to say, well, okay, what about something like, for example, a spread I'm looking at here is to say, well, okay, what about the H24, which is March 24, subtract December 24, and that's basically trying to capture sort of what's priced into the move of the Fed. And what we can see here is that this is just before, this is a 4-hour chart, and this is the spread between in the number of basis points. So you can see here this percentage. So 1 equals 1% or 100. Now, what we can see is before the most recent Fed, the fluffer, the fluffer of Jerome Powell, we can see that before he spoke, the market was pricing in, let's call it almost exactly 100 basis points of cuts between the period of March 24 and December 24. Okay, 4 cuts or 1%. Now, dovishly, everyone went, oh my God, they're going to be super dovish. So you can see that literally, again, a 4-hour chart, you can see that over the subsequent day or, let's say 24, 36 hours, the market went all the way down to 125 cuts, 125 basis points of cuts, 5 cuts. Okay, in that period from March to December. And then, of course, we see that it's kind of stabilized, and just over the last period, especially even, as recently as today, it's actually being sort of pushed up. And we can see that this is being, I don't want to say hawkishly, but it's being repriced. So what's going to be fascinating tomorrow if we get is the point that if the market really wants to go back to the Fed meeting and say, hey, Powell, you're not going to be cutting. There's more room to move, as we just saw from the SOFA Watch tool, that, potentially if it wants to go all the way back to the Fed, that would be another 15 basis points of this spread or that period of cuts, which needs to be priced out. And as we know, that's about 30 ticks just to get back to the pre-Fed level or so. So that's one way of playing it. Now, other ways of playing all of this, of course, it's pretty simple. We'll just go to a couple of, obviously, if we get hawkish data. Now, what's hawkish data? We get a higher than expected number, 1.5 standard deviations. So, something like, 185, 190, anything above, especially 200,000 jobs with no downward revisions, maybe upward revisions. If we get an unemployment rate which remains at, let's say, 3.7, if we get average hourly earnings, which is maybe, not going down too much, that would be anything hawkish, a hawkish series of number. Obviously, this is going to reprice sort of hawkishly the spreads, but also we can start looking at things like gold, and we've seen that gold in the most recent impulse has come off 50% onto the fib retracement here, and it's pretty simple. Gold on hawkish numbers or hot numbers is going to plunge through here and probably retest all the way, yes, down to the FOMC meeting, down to, let's say like 1998 or 2000. Let's call it 2000, nice even number down there. On the other hand, if we get sort of dovish numbers, of course, so we get a number, 1 or 2 standard deviations below the whisper number. So as we say, something like, sub 150, 120, something like that. If we get an unemployment rate creeping up to 3.8, 3.9, you get average hourly earnings coming down. That, of course, could give gold a nice pop out. It's going to be pretty simple. Obviously, if we start, I'm just going through my various charts here. If we start looking at the curve, we can see that, let's say the 2s 30s or the 2s 10s is kind of similar. We can see that if we get sort of a hawkish number, so again, a whole series of hot numbers, the curve could could flatten. It could flatten. It could bearishly flatten, and that basically means that the front end of the curve yields will go up more than the long end of the yields, basically on this idea that the Fed has to be repriced. Let's say the 2-year is the most affected, so that would probably flatten bearishly. On the other hand, if the data comes in kind of dovish and weak numbers, probably that could cause a bull steepening, the opposite. And very simply, the front end yields, let's say the 2-year yields, could come down a little more aggressively in this case than the 10-year or the 30-year, and that could steepen the curve a little bit. What is kind of interesting though, I won't go into that, but I just yeah, so that's what should happen with the curve. And again, if we just look at the yields here, if we see, let's say the 2-year yield, again, 4-hour chart here, very simple, guys. If the data comes in hot, you can short the 2-year. That's going to be, a pretty straightforward trade, and the yields will go up or the price will go down. Same for the long end of the curve. But again, technically, maybe the long end of the curve, the yields won't fall off as much as the front end of the curve. Other trades, if you look at we see that the dollar, this just like, let's say, for example, the dollar index, we can see that as part of this sort of hawkish repricing after Powell. We can see, again, this is Powell up here. You can see the FOMC, the dollar index was up here, and obviously it weakened, but it's been repriced about 50%. So same thing, if the data comes in hot, pick your poison. You could go and go along the euro, or maybe even something like the Aussie could be quite good, short the US dollar, basically. Other things which are kind of interesting, obviously, I'm not going to say obviously, but remember that high yields are generally not loved by commodities, and especially oil. Because remember that leveraged accounts and the cost to store oil and to drill oil and all this kind of stuff, it's all more expensive as interest rates go up. So in general, a high yield or a high interest rate environment is not good for oil. Also, the US dollar, commodities generally don't like a strong dollar. But so that's probably not the trade. It's probably something more to do with gold. The other thing as well, just of course, is our friends, the equities. And just by the way, guys, let's just keep a look here on the VIX. We see that the VIX is grinding up just as the equities are coming off. And if we look at the SPX, I'll just put it onto a daily chart here. We can see just the cash index here. I mean, it's pretty straightforward that there seems to have been some kind of profit taking in the new year, didn't quite reach the highs. If we look on the futures, the ES continuous contract, we can see that pushed through the highs. If we look at the NASDAQ continuous, it pushed through, and maybe this is new year profit taking, and probably just a bit of repricing at the beginning of the year on this notion that, the Fed, maybe the market is overly dovishly priced, and that maybe there won't be as many interest rate cuts coming in 2024, and so of course the equities are coming off. Now, this is not like a crazy retracement at this point. If we're looking at NASDAQ here, but for sure, if we get again hawkish data, obviously NASDAQ is going to be affected by that, and the S&P, but probably NASDAQ is maybe the simplest one. Again, opposite, if we get dovish data, that will be the trade. Now, what happens if we get mixed data? What do I mean by mixed? We get, let's say, prices paid, or sorry, average hourly earnings, which are sort of coming in sort of dovishly. And I'll just go back and we'll look at the numbers as we talk about this. Let's see if we have the numbers. I'll just bring it up again a little bit. I think we've got it here. So let's say, for example, we get mixed numbers. So let's say, for example, we get average hourly earnings coming in, I don't know, 0.1 or 0.2, but a hawkish headline number. I mean, that's going to be interesting, because remember that the Fed, they have two mandates. So for me, my instinct, my brain is telling me that a dovish number would, in theory, be good, quote unquote, for stocks. That's what I'm thinking here, because maybe on the headline that maybe the stocks would sell off, but one could make the case that as long as the inflation metrics are going down, that could be a buy the dip on stocks. However, I think that's a tricky trade, because another way of interpreting that, unfortunately, is also to say that, hey, yeah, we know that inflation and wage pressures is slowly moderating, but as long as the labor market itself remains very, very strong, it's maybe difficult to imagine a scenario where the Fed even needs to feel the need to cut more aggressively. So that's going to be a little bit of an interesting one. And vice versa, if we have, so what would happen, let's say, for example, if we have maybe a hot average hourly earnings, but possibly pretty weak sort of headline number, let's say like 80, 90, 100,000 jobs, but with so lower than expected jobs, but with the average hourly earnings, which was substantially higher, let's say 0.4 or 0.5, I think that would be a negative for stocks, because at that point we have inflationary pressures and wage pressures going up, but actually a weakening job market, which is what the Fed doesn't really care about, but they do care about the wages going up. So that, I think, would be, in my humble opinion, a fairly clear short in the equities. So that would be an interesting kind of situation there. What would be a perfect situation for the stocks as well? I mean, it's interesting. Is there a situation where maybe the stocks would benefit? It could be a situation where the headline number comes in fractionally soft. So a soft landing scenario. So what would that be? As we say, everyone's expecting 185,000. So maybe something not super weak, maybe something like 130,000, 120, 135, 118,000. But maybe we have the unemployment rate, at 3.8% as expected, but a little bit higher than last time. And maybe average hourly earnings, maybe it's 0.2. And we can say, hey, the Fed is happy with that because unemployment, is going up a little bit, but but the general economy is not too weak. So there's no recession, and yet average hourly earnings is going down. That could be a scenario which could be the sweet spot for stocks, and possibly the stocks would enjoy that. So I think, guys, that's probably about it there. I don't know if I need to think about anything else. As I say, personally, I'll probably be looking at gold and maybe the US dollar and maybe the short-term bonds. I think they're going to be relatively clean trades, but obviously there could be some interesting trades as well. And of course, those of you worrying about volatility, one way very short-term is maybe the VXX. If you feel like the stock market is collapsing, that's one way. Maybe just some call spreads or something like that on VXX. If the stock market does start to go down pretty hard. Okay, guys. So hope that was useful, and good luck. Thank you so much. I'll end it here. Thank you.